So what if I told you that one of the biggest pieces of financial advice you've probably ever gotten, avoid debt, is, well, maybe not the whole story. Today, we're going to break down a strategy that completely flips that idea on its head, and we'll see how debt can actually become an incredibly powerful tool for building some serious wealth.
From the time we're kids, right, we hear this simple message: debt is bad. It's this heavy weight, a burden, something you want to stay away from at all costs. But for a certain group of wealthy investors, debt isn't a bad word at all. It's not a burden, it's a tool, a really powerful one. And, understanding this one little shift in mindset is the absolute key to everything we're about to get into.
So, how can that be? How can debt be both a burden and a tool? Well, it's because not all debt is created equal. The real secret here isn't about what you owe, it's about what that debt lets you own.
Okay, here's the fundamental difference, plain and simple. On one side, you've got what we can call bad debt. This is the stuff we're all warned about. It's when you borrow money to buy liabilities, things that just go down in value. Think about a new car that depreciates the second you drive it off the lot, or a vacation you put on a credit card. But on the other side, you've got good debt. This is when you use borrowed money to get your hands on assets, things that can actually make you money, either by going up in value or by producing income.
And this right here, this is the crucial point. Good debt is strategic. It's an investment. Yeah, you're taking on a liability, the loan, but you're doing it to buy an asset, like an income-producing rental property, that has the potential to pay for itself, and then some. This is the bedrock of the entire strategy.
So this brings us to the core concept, the real engine that drives this whole process. It's a little something called leverage. And really, the simplest way to think about leverage is using other people's money, or OPM. In this case, we're talking about the bank's money to multiply your own financial power.
And this isn't just some theory, it's the very reason why so many of the world's wealthiest people have made their fortunes in real estate. It's not just about being great at picking properties, it's about the incredible power of leverage. So let's break down exactly how that works with a simple example.
Imagine you've worked hard, you've saved up $20,000, and you're ready to invest it. This is your capital, your skin in the game.
But because you're buying an asset like real estate, a bank is willing to come to the table and lend you, say, $80,000 against it. This is the OPM, other people's money.
And here's where the magic happens. Your $20,000 plus the bank's $80,000 means you now control a $100,000 asset. See what happened? You've leveraged your money, multiplying its power by 5 times. You're not just playing with $20,000 anymore. You're commanding an asset that's worth 5 times that much.
Okay, so that's the theory. But how does this actually look in the real world? How do you put this into practice? Well, it all comes down to a pretty straightforward 4-step playbook.
On paper, it's actually a remarkably simple process. Step 1, you get that loan we just talked about. Step 2, you combine that with your down payment to buy the property. Now here come the critical parts. Step 3, you find a tenant to live in your new asset. And step 4, you use the rent that tenant pays you to cover the mortgage payment to the bank. Think about that for a second. You use the bank's money to buy an asset, and now you're using your tenant's money to pay the bank back.
This whole setup creates 2 potential ways for you to build wealth, often at the exact same time. You can think of it like having 2 engines pushing your finances forward.
So engine number 1 is asset appreciation. The entire $100,000 property can go up in value, not just your little $20,000 slice of it. Engine number 2 is cash flow. If the rent you're bringing in is more than your mortgage, your taxes, insurance, and all the other expenses, you're left with pure profit in your pocket every single month.
And this right here, this is, without a doubt, the most powerful idea in this entire explainer. So just let it sink in. If that $100,000 property goes up in value by just 5%, that's a $5,000 gain. And you get to keep all of it, even though you only put in $20,000 of your own cash.
Let's put that into perspective. If you put your $20,000 into the stock market and it grows by 5%, you make $1,000. Hey, that's a great return. But with our leveraged real estate example, that very same 5% growth on the entire $100,000 asset, that gives you a $5,000 profit. On the exact same initial investment, you've made 5 times the money. That is the multiplier effect of leverage in action.
Now, it is absolutely critical, and I mean critical, to understand that this kind of reward does not come without risk. This strategy is a high-powered tool.
And anytime you're dealing with that much power, things can definitely go wrong. This is the other side of that powerful coin we've been looking at. Because just as leverage supercharges your gains when things go up, it will supercharge your losses if things go down. It cuts both ways, and you have to be ready for that.
So what does that actually look like? Well, a market downturn could mean your property's value drops below what you owe the bank. You could have a vacancy for a few months where there's no rental income coming in, but guess what? You still have to pay that mortgage. A new roof, a broken furnace, these things can lead to massive unexpected bills. And of course, rising interest rates could jack up your mortgage payment, completely wiping out your profit. These are very, very real risks.
So we come right back to where we started. Debt is a tool. Leverage is a wealth multiplier. But here's the thing, it's indiscriminate. It doesn't care if it's multiplying your wins or your losses. And that leaves us with the one real question you have to ask yourself. Is this a tool that is going to work for you, or will it become a burden that you end up working for? Because the answer to that question is the difference between building a fortune and digging a very